Well, hello trading friends, and welcome to video 2. This is the second in a series of 3 videos. In the first video I just sort of set the scene about foreign exchange trading, and this video is all about the nuts and bolts. There's just some stuff that you're going to have to learn and know. A bit like, if you're going to build a fence, you're going to need some tools, you're going to need some posts and some rails and some palings and a measuring tape and a string line. You need a little bit of information before you just dive in and try and build a fence. Just like the guitar, if I said to you, here's a guitar, play me a G chord, and you'd never picked up a guitar, you don't have enough information. You need to know to put, your index finger on the 6th string on the 1st fret, whatever it is. So this video is really designed to just give you enough knowledge about the markets and how we trade, and cover off a lot of the lingo. There's a lot of lingo in this game. So without further ado, I'll try and get through this as quickly as I can. And what you're seeing on the screen now is a quick presentation that I put together for you. So let's do that. So the basics of Forex trading. Let's get into it. So I've got a lot of topics to cover here today. We're just going to look at the market, supply and demand, and buying pressure, selling pressure. We'll look at currency pairs, we'll look at the major pairs, different types of trading. We'll look at the main market sessions, cover off a bit of the lingo. We look at buying and selling and how we do that and how we measure the amount that we are buying and selling. Managing our risk, managing our money, having a playbook. It's a trading plan that you stick to, and a little bit about journaling and reviewing your results. So let's get straight into it. The foreign exchange market. Let's talk about supply and demand and buying and selling pressure. So on the screen here we have a chart. It's a 15-minute chart. We're looking at the Euro USD, and we can see the prices are going up and down, up and down, up and down, up and down. And you'll see in certain areas of the chart where the price goes down, and other areas of the chart where the price seems to go up. And this is buying and selling pressure. So it's said to be bearish if the price is being pushed down, as you can see here on this area of the chart. And this is where there is more selling pressure. Now, you probably know a little bit about markets, you know about supply and demand. If everybody wants to buy coffee all of a sudden, and there's not enough coffee around, the demand will outstretch the supply, the price will go up, and vice versa. In foreign exchange, it's more about pressure. As I said in my first video, really big banks can put a lot of pressure on in the market. So if JP Morgan decides to buy 500 million euros from Merrill Lynch, that interbank trade is going to put a massive amount of buying pressure in the market, and the price will go up. Now, us retail traders, we can't put on any pressure like that. Not me, not my neighbours, not all my best friends, not New Zealand and Australia put together in a single trade. We can never exert the same amount of pressure as the big banks can apply to the market. So so where we have more selling pressure, the price will go down. The big banks will move the market in this direction, and when they go on a buying spree, they will apply more buying pressure, and the price will go up. And we've heard about bulls and bears. So the bull has the horns and can push you up in the air and push the price up. So if we say things are bullish, the price is going up, and a bear will stand up with his huge paws and pull you to the ground and eat you, and that is what we call bearish, when the price is being pushed down. Okay, let's have a look at sessions and candles and trends. What we see here is just a little piece of a chart, and you can see on this chart we have a Tokyo session or an Asian session, a London session, followed by a New York session. There's actually what they call a Sydney session, which is prior to the Tokyo session. Even though it opens in Wellington at 9 o'clock in the morning, it's called a Sydney session for some stupid reason. But we're not worried about that session. We're only going to be focusing on the Tokyo session, the London session, and the New York session. You can see here we've got green candles, and what a green candle represents is an increase in price. So this candle has opened at the bottom here, has been pushed down a bit, it's probably gone red, and then it's come up and gone right up and come back and closed higher. So this is a 15-minute candle, and the price has gone up, so it's green. Here we have a red candle. Now this candle, the price is opened at the top here, it's gone up, it would have gone green at this point, but it's been pushed down, down, and closed at the bottom. So that is a reduction in the price. Now we have some small candles. Here's a little small candle. And we have some massive candles. So when we see these big candles, green or red, these are the big banks moving the market and going on. In this case, they're going on a massive buying spree up here. You can see all these big green candles. These are really big banks, all buying, all aggregated, all going in the same direction and pushing the price up. Now this candle has what we call a pin. So it opened here at the top because it's a red candle, and it went up slightly. It would have been green here, and then it got pushed all the way down to the bottom, and then some buyers have got in here and pushed the price back up. So it's still closed. It's still closed with a lower price, but it has a big pin at the bottom, and we'll talk about these pins and what they mean when we are looking at charts a little bit later on. And finally, here are what we call some trends. So you can see that the price was pushed down here by the big banks, and then they went on a buying spree. They pushed the price right up to the top here, and then they reversed the market and came down, and then they went back up. And you'll see that these trends occur every day in the market, particularly in the London and New York sessions. Okay, so the major foreign exchange pairs. I'll just run you through this. This is a bit of an AI overview from Google. It says that the major currency pairs in Forex trading are those involving the US dollar, okay? So only US dollar pairs. And these are typically the most liquid and actively traded currency pairs. So there are 7 major pairs to pick from. We are going to pick one. And I want you to stick to one pair, and we're going to go with the biggest pair, and that is the euro versus the US dollar. Okay? So these pairs are popular due to their high liquidity. It means that they move a lot. So there's a lot of buying and selling activity, leading to tighter spreads, and I'll explain what a spread is shortly. They're also generally considered more stable and less volatile, and this is very important. If we were trading the Turkish lira versus the Indian rupee, those currency pairs could be very, very volatile. They could jump all over the place, whereas the really big major pairs are a bit more stable, making them suitable for both beginners, that's you and me folks, beginners and experienced traders. So these are the major pairs. The other pairs are called cross pairs, and they have any currency pair without a US dollar in it is called a cross pair, but we're not interested in them. We're only interested in the Euro USD. Okay. So here is a chart of the Euro US dollar. It's a 15-minute chart. That means every one of these little candles represents 15 minutes. And I'm just going to bring your attention here. This is over on the right-hand side here. If you can see this little green indicator here, this is the current price as of the time that I took a picture of this chart. We're looking at the Euro US dollar, and what we have is the Euro, which is the base currency. It's called the base currency, and the US dollar is the quote currency. So this little price over here on the right, which says 1.17862, just show you that there in the box, blow it up a bit for you, 1.17825, sorry. This is how many US dollars we would have to pay to buy €1. So we'd have to pay $1.17825 American dollars to buy €1. So we trade these against each other. So if the euro goes up in price, we will make money. If the US dollar goes down in value while we're buying, we'll also make money. So it's a trade-off between the two currencies. Now, these currencies are measured in what we call pips. And 1 pip, which stands for the point in percentage, don't worry about what it stands for, is the smallest measurement of price movement that brokers will, pay out on, basically. And it's the 4th decimal place. So, to give you an example, if the price went from 1.17825 to 1.7895, we've effectively gone up 7 pips, okay? And if you're getting paid $10 per pip, that would be a $70 US payout for you. And we'll come to the payouts later and how that works. Now down the bottom of the chart here, you can see this blue line, and that's an indicator called the average daily range, or the ADR. And you can see that it goes up and down over time. And if we put a line through the middle of that, roughly through the middle, we'll get the average number of pips that this currency pair would move in any single day. And if you can see on the side of the chart, it says 100, which means 100 pips. So for this currency pair, it is likely to move 100 pips any day of the week. And that's really handy to know, and I'll tell you why later. So just keep that in the back of your mind, 100 pips. Okay, a bit of lingo coming up here. Here's our chart again. And we are at market here. So this is just a picture of a live chart. We're at market, so whatever price is displayed on the right-hand side is the current price at the time. And I'm going to blow this up for you because there's a couple of little lines here. I'm just blowing up this area of the chart. You'll see that there is a red line and a blue line. And the red line is what we call the ask, and the blue line is what we call the bid. So the big banks that supply liquidity to the brokers will publish an ask price and a bid price, which gets passed on to us. And what the ask price is kind of like, what are you asking for this? What are you asking for this currency right now? And that there is the ask price, and it's the price at which the banks or the brokers will sell to us. So if we're buying, they're going to sell to us at the ask price. And likewise, if we're buying, the bid price is, think of an auction. The current bid for this, car is this price, and when we buy the currency, this is the bid price, is the price that the brokers and the banks will sell it to us at. Okay, so that's the ask price and the bid price. Now, if you see up here on the left-hand side of the chart, you'll see we've got a sell and a buy button, and we've got a little number in the middle. I'll just blow that up for you. This little number in the middle, 1.2, it's known as the spread, okay? And the spread is the difference between the ask price and the bid price. And when we buy or sell currency, our broker will preload our trade with the spread amount. That's effectively the amount of money that they make on every trade. So if I'm buying, the price would have to go up 1.2 pips before I actually got into the money. Okay, but we'll explain this a bit more down the track. I know this might sound a little bit technical, but these are just basic, it's just lingo, okay? So if I say to you that the spread on the Euro USD is very tight and it's small, that's good for us because it means that the effective commission we pay on each trade is going to be smaller than if we were trading, say, the US dollar versus the New Zealand dollar. Depending on the time of the day and the volume, the spread could be massive, and that makes it a little bit more uneconomic for us to trade those other pairs. So that's a little bit of lingo for you. Types of trading. It said that people use either technical analysis, what they call TA, or they trade the fundamentals, which is mainly the news and what's happening in the world, what's happening in big economies and big announcements, a change in president or a change in interest rates or big announcements coming out of the Fed. Some people trade those news events, but what we're going to focus on is technical analysis, and what that means is we're going to observe the price action in real time, and we're going to buy or sell based on patterns and indicators. And the particular strategy that I use, I'm going to show you, is all about a pattern and the right timing and the right levels, okay? And we'll cover that in the next video when we actually get right into trading it. Just want to talk about time frames. Traders can often trade very different time frames. So these young guys that scalp the market, who sit in front of the screen, for 8 hours at a time, high on Red Bull and adrenaline, they would typically trade the 1 minute chart or perhaps a 5 minute chart. So every minute there's a new candle printed, prices are going up and down, and they're scalping. They're making a small amount of money on each small movement in the charts. We're going to be medium, okay? We're going to trade the 15-minute chart. It's not so noisy, and if we can come back to the chart every 15 minutes during the times that we trade, that's a pretty reasonable ask. If we're trading for between 7 o'clock at night and 9 p.m, if you're able just to check in on the chart every 15 minutes, that's not a big ask. Some traders trade very long time frames, so the 4-hour chart or the daily chart or even a weekly chart, and these are sort of more positional traders. So what we're going to do, we're going to trade the 15-minute chart, and we'll show you that in the next video. I want to talk about the big news and how we might track it. Now, normally, under normal circumstances, news events don't really affect the foreign exchange market, particularly when it comes to the big banks. News doesn't really bother them. In fact, they'll often make their big moves at exactly the time that some news events are coming out in the market. But we do need to keep our eye on the really big news. And we can go to a website. We'll show you how to use this in the next video. It's called babypips.com. And at that website, they have an economic calendar, and we can filter out everything but the US dollar and the euro, and we can look at the calendar for today, and we'll see that there's some big news coming down. Any big news in red is a high impact, and we don't want to be in the market at that time, because if we have an open trade at that particular time at 2 a.m. and the news goes one way or the other, it's a bit of a gamble. We don't know which way it's going to go, but it could really affect the price and spike the price and knock us out of our trades, or we could effectively lose a bit of money. So babypips.com is your trading companion to avoid event risk. And event risk is anything that will move the markets, but that you can't see coming. So basically it's saying don't be blindsided, keep your eye out on the big news, and we'll show you how to do that in the next video. So there's the website, babypips.com/economic calendar. It's free, it's awesome. In our charts we will also see, and I'll show you this in the next video, you'll see a bunch of news that comes up, and a lot of this news is put out by Reuters and a whole bunch of media companies that I've kind of never heard of, and a lot of this noise is kind of targeted to spook the retail market. And you can see in the charts here that we have little indicators of the news as it's coming down the line, and we can click on this little US flag here and it'll give us more information about what those news events are. So just a heads up, we're going to keep our eye on the news. Okay, I'm going to talk about sizing now, talk about lots and units, and this is a bit of jargon, but it's the way that we measure the size of our trades, or our positions as they're called. And there are 3 different sizes of trade. What we call a standard lot, a mini lot, and a micro lot. Now a standard lot is the biggest size we can trade. It's effectively 100,000 units. So if I'm buying one lot on the Euro USD, I'm buying 100,000 euros. Now if the price goes up 1 pip or down 1 pip, it's worth $10 US as a payout or a loss. Mini lots are 10% of the size, so the 0.1 of a standard lot, this is what we're probably more likely to trade, and I'll show you that in the next video. But effectively, one mini lot is 10,000 units, and if the price goes up or down 1 pip, we make or lose $1 US, and micro lots are very, very small, but quite good to, I use a micro lot trade sometimes a bit like a tracer bullet, just to keep my eye on whether the price is going up or down. It's easier for me to see it in a price than it is to stare at the detail of a chart sometimes. But we're going to trade mini lots, and it's not a big deal. You'll see in the next video, once we are using the platform, it takes all of the lingo out of it. Okay. So if we're looking here again at our Euro USD, we've got our base currency and our quote currency. If we're buying 0.1 of a standard lot, we're buying 10,000 euros at this current price of 1.17825 US dollars. And if the price goes up to 1.17895, up 7 pips, we would make a $7 profit if we close the trade. If we close the trade at that price, $7 profit would go into our trading account. Now, leverage and margin. This is pretty important to understand. I'm just looking here at the advert on the internet for my broker, blackbull.com, and it says up to 1 to 500 leverage. So what does that mean? It means I can actually trade a position 500 times larger than what I have in my account. So for example, $100 US, if I had it in my account, I could actually trade a $50,000 US position, so 500 times larger. Now if the price goes up 1%, this is in theory, I would make US $500. And if the price went down 1%, I would lose US $500. So without leverage, I could only make or lose $1 on my $100 if it went up or down 1%. So you can see that leverage gives us a great amount more money to be trading with, but it also comes with high risk. You can win big, you can lose big. You can win small and you can lose small. Now, trading with leverage requires that you have enough capital in your account to cover the trade, and this is what they call margin. And if you exceed your margin in one or more trades, your broker will issue a margin call, and that is they will request that you deposit more funds to cover their risk. And if you exceed the broker's margin threshold for risk, they will liquidate your open trades. They will close your trades, and you could lose up to 100% of your trading account. So we really need to manage our position sizes and our risk, and I'll come to that shortly. But this is just a heads up on leverage and margin. It's a good thing and it's a bad thing, but we'll make it a good thing by trading properly and managing our money, our position sizes, and our risk, and I'll come to that shortly. So there are three elements of a trade. I'm looking here at our chart again, and perhaps in this Tokyo session we see a beautiful W pattern show up in the chart, and we think that the price is going to go up, that the banks are going to go on a buying spree. We won't have seen all of this stuff. We'll just be here at this green candle. But we're anticipating a trend, okay? That we're anticipating that the trend is going to go up, and we want to get in on the trend early. So we have an entry point here. This is where we decide to buy. In this case, we're going to buy. We set a stop loss, which is underneath our entry position. And what that does is to protect us. So if the market does reverse and come down, we can only ever lose what we set as our stop loss. And then we set a take profit target. And what that means is what price do we want to close the trade, and how much profit do we want to realize in this particular trade. So we have three elements of a trade: the entry, the stop loss, and the take profit target. Now all of this will become very clear when we use the platform, because it's just a doddle to do, but I just need to explain it. And in this example, which is a buying example with a market order, so a market order, we're just buying at the current market price. We are only going to be interested in market orders. We're not going to do anything else. There are many different types of order. There are limit orders and orders that will trigger when things hit a certain price. We're not going down that path. We're just going to trade at market, okay? So managing our risk and reward, let's have a look at that chart again. So we're going to enter here, and we're going to buy 0.2 lots, and I'm going to show you how we calculate the size of our buy position based on our account balance and how much risk we're prepared to take. I'll show you that shortly. But we've got an entry. We're going to buy 0.2 lots. We're going to set a stop loss of 20 pips, which is going to be 1% of our account balance. So if we lose this trade, the most we can lose is 1% of our account balance. We'd have to lose 100 trades in a row to blow our account. And our take profit target, in this case, we'll set it at 40 pips, which is twice what our stop loss is. And if the price comes to that level, the trade will close, and you'll get a payment from the broker into your trading account instantly. So we're going to talk now about the position size calculator. How did I come up with that 0.2 lots? Well, we can go to babypips.com again, and they have a really cool tool. It's called the position size calculator. This also happens in the trading platform automatically. I'll show you that in the next video. But if you wanted to manually figure it out, your account currency is generally always US dollars. You put in your current account balance, and in my case it was $2,000. I want to take 1% risk with a stop loss of 20 pips based on this pair, and then you hit calculate, and it says the amount that you can risk on this trade is $20 US, and the position size is 0.1 standard lots. So this little tool will actually figure it out for you, and it's just quite cool to use and have a play with. You'll find that at this address, babypips.com/tools/position size calculator. So have a look at Baby Pips, have a look at the tools menu, and see if you can find it. Now we're going to talk about market session timing. Now the particular trading strategy that I use, it's absolutely critical that we have our charts set up with the right sessions and the right timing of those sessions. Now if we go to babypips.com again, in the tools you'll find a FOREX market time zone converter. You'll see here the 4 different sessions that we have in a 24-hour period. The Sydney session, which actually opens in Wellington at 9 in the morning. We're not interested in that. We're interested in the Tokyo session, the London session, and the New York session. And you'll see we have this little thing here, and we can move it around You'll see that the time zone that we have set is for Auckland in New Zealand. That's very important. And we can move this little guy around and see exactly when, for example, the Tokyo market opens. Also see down the bottom, it's pretty cool. It just gives you a bit of an indication of at that time how much volatility or trading volume there is in the market at that time. And we tend to trade in the green bits where there's lots of trading activity. So babypips.com/tools, have a look there and have a play with this foreign exchange time zone converter. In the next video, I'll show you how to set this up properly. So once we have the local time for the Tokyo session opening and closing, we'll make sure that the sessions in our trading platform align with these local times, because the server that we trade from could be in New York, it could be in another time zone, and we need to make sure that the offsets are correct so that when it says the Tokyo session is open, it actually is open, because our trading strategy, it's critical that the timing is right. Okay, but we'll show you that in the next video. Now, your daily playbook. This is something that's quite important. With trading foreign exchange, there's lots of different things you can trade. There's lots of different time frames. There's lots of, different strategies you can use. And what the playbook is designed to do is just to take all of the guesswork, all of the options out of it, and you're just going to follow a single playbook every single time. And this is the playbook that I want to teach you how to use with my strategy. So here are 9 questions that I always go to every day. The first one being, are you feeling okay? You're not drunk, you're not tired, you're not angry, you're not depressed or anxious. If you're feeling good, you can trade. If you're not feeling good, don't trade, because trading is a really emotional game. And if you're pissed off or down or depressed, or you're drunk, or you're high, or whatever you are, then that's just no good for trading. I'm sorry. Next question: are you in the right environment to trade? I generally trade at home on my PC. It's a nice quiet room. You've got to be in the right environment, guys. If you're in the pub and it's noisy and you've got 5 mates standing in front of you and you're on your phone trying to, open and close trades, you're going to make mistakes, you're going to be distracted. Don't do it. What exactly are you trading? Now, in our case, it's the Euro USD. It's always the Euro USD, okay? Don't step outside this playbook. What time frame are we trading? We're trading the 15-minute chart. Don't ever step outside this time frame. What's your trading strategy? Well, I'll show you mine. So in my case, it's my own beat the market maker strategy. When will you enter the market? So at the top or the bottom of the day before the London session. Typically, that's when I'll get in there. Now, there's variations on a theme. Things can change. Things don't always show up at the exact same time, and the market makers will change when they make their moves, because if they did it at the same time every day, the traders would get onto it straight away. When will you exit? Well, I always exit with a 30 pip take profit. Now remember that 100 pip average daily range that I talked about? We have 3 sessions, the Tokyo, the London and the New York. If you divide 100 by 3, you roughly get 30 pips, don't you? So having a few pips up your sleeve for a pretty crappy entry, if you don't quite get it right, you can take a 30 pip take profit very reliably, knowing that you'll make that amount of money. Whereas if you don't know what the average daily range is and you say, I want a 100 pip profit, well, you're never gonna get that. So, but we'll cover this in the next video. How will you manage your risk? Well, I'm only going to risk 1% of my account balance, and I'm always going to run with a 20 pip stop loss. And I always run with a 20 pip stop loss, because retail traders run with a 5 or 7 or 10 pip, and the market makers know this, and they will stop them out. They will screw them over, and we want to give ourselves a bit more breathing space. So I always trade with a 20 pip stop loss. What hours will you trade? 7 till 9 p.m. is typically when I will go to the screen. I'll see the opening of the London market. I'll have my eye on things on my phone over the course of the late afternoon, but generally I'll be there from 7 till 9, and generally the trades will they'll come off before midnight. I can go to bed, and that's okay. There is one other thing that I would always check, and it's not on the slide, but we're going to quickly check the news. And as I mentioned before, I'm going to show you that in the next video. So this is a framework to keep you focused, okay? If it's all in the playbook and you follow the playbook and you don't vary from the playbook, you'll be way more consistently profitable, I guarantee it. If you dive off into another currency pair and start trading the euro, Japanese yen or something weird, and that's a very volatile market, and you get you lose your trades, you get stopped out because of big price fluctuations, then that's on you. If you stick to this playbook, I guarantee you'll be more successful. And we'll cover this in the next video when we play some trades, and I'll run you through the playbook, and it'll make real sense, okay? Right, last slide, I think. Keep a daily journal. Now, I keep a daily journal. It's basically a spreadsheet, and you can see here it's a 24-day spreadsheet with 4 weeks results. So we've got 1 week, 2 weeks, 3 weeks, 4 weeks. I start the spreadsheet with my opening balance, and every day, whatever the closing balance is, I record my profit and loss and what that was worth and whether I won or lost, and I keep a tally of sort of my daily win rate and my daily trading win rate. And where I have a loss, I can sort of quickly ask myself, well, why did I get that loss? And it just solidifies, when you do lose, the reasons for it in the effort that you're not going to make the same mistake again. So that's why we keep a daily journal. It's really to motivate you. It motivates me every day to see how I'm going. Now at this point in the spreadsheet, yesterday I was up 9.72%. Last night I had a bit of a clanger, and I think I lost about $90. So it reduced my profit from 9.7 down to 5.6% for the 4 trading weeks. But that's not to be sneezed at. If you can make 5% in a month, that is awesome. The rockstar traders and the big banks, the hedge fund managers, if they do 20% per annum, they are rock stars. So if you can do 4 or 5% in a month, 1% a week, that is awesome. You're out trading the biggest managed fund, people in town, or you're outperforming them. So that's awesome. So anyway, that is the quick update on these are the basics, folks, that you're going to need to know. And I know there's a lot of jargon, and it probably sounded really confusing. And I want you to watch this video a few times if you can. And things will become very clear in the next video. But like building a fence, if you've never built one before, you need to know what tools, you need to know what product, you need to know what you're going to need and how you're going to do it, and have a plan. And this is the stuff I've covered in today's video. It's a very entry level, the basics of foreign exchange trading. But I hope I know you'll get some benefit from it. And I'll be back with the 3rd video, and this one's going to be cool, because in the 3rd video, let me just go through to my last slide here. In the 3rd video coming up, the next video, I'm going to show you the winning strategy based on how the market makers move the market every day. This is the one strategy that I've been using since the 23rd of February. We're going to install TradingView on your PC or your tablet or your phone. Very straightforward. It's completely free. Install it, and you just set up yourself an account. Then we're going to set up a paper trading account. We could start that with $5,000 US. Now it's paper money. It's like Monopoly. It's not real, but that's a reasonable amount of money for you to see some good wins and some not so good losses. We're going to set up the indicators that you need to trade the strategy. There's a few indicators that I use, and I'm going to set those up for you, show you how to do that. Then we're going to play some trades, okay? So we're actually going to go buying and selling, and we'll set stop losses and take profits, and we'll watch the charts, and we'll see these trades close, and you'll see your paper trading account grow in value. We're going to show you the money. So, you know, until the next video, I look forward to seeing you here again, and have a great week, a great weekend, and we'll catch you next time. Cheers.